Hi, this is Marcel, your personal assistant in fighting fear, uncertainty, and doubt. No, just kidding. But of course, yeah, we have quite some bad news around stocks like Baidu dropping 25% in only 2 trading days. So that's not quite usual, right? We have fear around delisting. What could it, for instance, mean for NIO? We've got bad news around NIO for the chip shortage and so on. So let's look at this one for one. And then I tell you my thoughts around where I think this is kind of overblown and where I think, well, we should pay actually attention to that and also kind of be frankly ready to make adjustments in case that something goes wrong. So let's start with the delisting fear. And I've done a couple of videos around this topic before. I mentioned like how this is kind of really connected to Chinese stocks and also the way they are listed. If you want, you can go and watch them back. It's both affecting NIO and Baidu and other Chinese stocks across the board right now. In my last videos, I talked about how political reasons have now affected the Chinese stocks recently. And one card in this ongoing battle between the US and China, and also now Europe and China, is actually, well, of course, the US could actually delist Chinese stocks. And now they're coming forward with some news that, well, actually, now it's going into the next process step of actually a public hearing around the Delisting Bill. So if you're interested, you can go to congress.gov and find the bill, the Holding Foreign Companies Accountable Act, and you can see all of the progress of how it became a law. You can read the text actually of the entire bill and so on. But now let's just focus on what is the news around it and what does it all mean. So the whole thing is about the US threatening to delist Chinese companies if the Public Company Accounting Oversight Board is unable to audit specified reports because the issuer has retained a foreign public accounting firm not to subject to inspect by the board. So that's one thing. Chinese companies are currently audited by, well, the big companies like PricewaterhouseCoopers, Deloitte, and so on, but of the Chinese representative office of those companies in China. So these audits are not shared with the PCAO, and that's because the Chinese state actually regards some of these informations, the financial informations of some of these companies as state secrets and thereby not sharing it. And ultimately, I hope actually that the Chinese would actually make a step towards the US there, and for some companies allow that. For instance, we had recent news that NIO actually said they believe they are compliant with that because there should be ways that actually they can make those financials overviewed also by the US counterpart, for instance, of those auditing companies, but also by the PCAOB. But of course, I could imagine that for some state-owned critical companies that are still US listed, for instance, more in the energy or telecom sector, that they indeed would have a problem sharing such kind of information. So they may actually not commit to that and will likely not be able to let their numbers be audited later on. Now, in all the other Chinese companies' case, I do think that they would actually agree to such an oversight and that they would have no problem. And I think that's the deal which both China and the US ultimately will actually reach. And I think it's good. It's good for investors. It's good for transparency. And it should also be good for both China as well as the US. Now, there's one more aspect of this bill, which is around government ownership or also Communist Party membership of board directors and company executives. And well, according to this bill, they need to disclose such kind of information, like how much government entities have a controlling financial interest in the company, who of the board members are officials of the CCP, and so on. And I think, in my point of view, this is really not a big issue in most cases. Now there are more than 90 million party members, so party members that actually Germany has inhabitants, so it's a quite big number. So it's really not unusual that you have a company director that's actually a party member. And I don't think, considering the Chinese political system, that this is something unusual. And of course, also the US legislators should know that. And therefore, I think just this kind of disclosure, having that kind of disclosure should actually be not a problem and should also not surprise anybody on the outcomes that there should be actually board members or executives that are members of the party. But that's not leading to a delisting of the stock. It only means that they need to disclose that, where I think there shouldn't be a problem. Where there might be a problem is where the government has a huge stake, like equity stake in the company, which kind of means that they can also control the company. company. And well, also on an international level, that's not quite unusual. Even Volkswagen is, I think, up to 25% owned by a German local government. So there is just stuff like this happening, not only in China, but also in other countries. Well, now in China, there are obviously some companies that may have ties to military or might be closely connected to government. And yes, for them, there might be an issue, as I mentioned before, with disclosing those numbers and also revealing this government stake. And these companies, I think, may be the ones. There's also a preliminary list by the US about those companies. And I think these companies, yes, they may actually have an issue with this Holding Foreign Companies Accountable Act in the end. And now that we have new news about enforcing this kind of act coming around in the media, also possibly parts of the ongoing negotiations between the US and China and the Xinjiang issue, for instance, or also the Atlantic meeting which they had. Well, that leads now to fund managers being much more cautious about this Chinese stocks. Maybe some of them actually have to trigger a sell in order to be either compliant or to reducing some risk. And we've seen that, for instance, now in Baidu stock, which dropped here 25% in only 2 days. And I think one reason is that they may actually have some closer tie to the Chinese government than other companies. So, for instance, there are more question marks around whether or not Baidu could actually cope with such kind of a regulation. In my point of view, I think they would be able to do that. And second of all, I noticed lots of action in the options trading in Baidu shares. So with the recent run-ups and lots of volatilities in the auction, the premiums were quite high. Then they had a volume crush on the premiums and so on. And possibly there is something going on of kind of some funds recalibrating around their Baidu positions and maybe have to, cover some options there. All I can say that yesterday I used this as a buying opportunity because I think that was kind of overblown in my point of view, an overreaction, and I went both into short-term as well as long-term Baidu call options, but also bought some more of the common stock because I actually think that the valuation of this company is not really truly reflecting yet of what's to come in the future with Baidu. So I thought that was actually a cool dip in order to double down on my investment here. But let's get back to what would actually happen if the stock gets delisted and also where I would pay attention to. So in my point of view, having a share of a company constitutes ownership in this company, right? So you have a piece of paper, or now it's digital, that actually says that you own a certain share of the company and no one can take that away from you. The fact that the company is going to delist it means that it's just not going to be traded at a certain exchange anymore. So now what Chinese companies are currently doing is, for instance, some of them are making secondary listings in Hong Kong, so you can buy the shares there. In some cases, you can also buy the shares, for instance, in Frankfurt or other exchanges. That's usually also in other currencies. So in general, that's kind of diversifying the risk. I buy most of my Chinese shares actually in US dollars, listed in the US stock exchanges, but it's possible that they get delisted there, and then possibly they will be traded over the counter or OTC. Big stocks like Tencent are trading over the counter, and this still means that there is a market for the shares, just that they are not trading at the official indexes or exchanges anymore. And that may have a negative implication on the stock price because the stock will become less liquid and there's possibly less volume in people trading it. And that's also why people may actually sell it on such news because they think they want to get out before the stock price goes down. However, you still own the piece of the company, and so it's going to be traded somewhere, and at some point in time, people will assign a value to this company, whether or not this is traded in Hong Kong, in the US, or in Frankfurt. That doesn't matter so much. But yes, it can certainly depress the stock price, but it wouldn't take away your ownership. So that's the way to think about it. So this is why I'm actually paying more attention to what the Chinese companies are actually doing and saying instead of what the US regulators are saying. If at some point Chinese companies would say, we buy back our shares or we are just not interested in foreign investors anymore, that would strike a red flag for me. And that's where I would start considering also selling, for instance, my NIO or Baidu stock. But so far, what they're saying is that they want to act in the best interest of their shareholders. So I'm not not worried too much about this so far. To sum it up again in a nutshell, I think the legislation is on the way, and I also think that the US and China will actually negotiate a compromise or some sort of an arrangement that will actually keep the Chinese stocks listed in the US, because frankly it would also be a big loss to the US exchanges if they lose all of the trillions invested in Chinese companies, and also actually kind of strengthen the other stock markets then, trading in euros, trading in Hong Kong dollars, and making those other exchanges like Hong Kong Stock Exchange actually more important would be, in my views, kind of a blow to the USA as a place to buy and hold stock. Then in the case of Baidu, we have additional pressure around policies made in China and kind of curb with the big tech in order that they want to fight monopolies and kind of also have more to say about how user data is being used and so on. I think for my investments like Meituan and Baidu, I'm really not so worried about the implications of that. Also, the CEO of Baidu mentioned this in this recent interview.
Regulators here are now squarely focused on an anti-monopoly regulatory change, reining in financial technology. How do you think the technological regulatory environment is going to change in China? How is it going to impact a business like Baidu?
I think antitrust is also good for innovation. You just cannot imagine, the number one and number two guy all of a sudden merge and gaining more than 90% of market share in the US. But that happened quite a few times in China before. That's not good for innovation. So I think that the antitrust push is kind of justified.
You studied in the US, of course. You've built an incredibly successful business here in China. Where do you think the US-China relationship is going ultimately?
Well, I don't have the crystal ball, but my preference is certainly that both countries can work together. And I think by working together, a lot of things can be done faster and the world will be better off. We will benefit from a very large market and the government policy to encourage innovation. But we also benefit from our US partners. They supply parts, they help us to grow faster. I very much like to stay coupled instead of decoupled.
So yes, this policy is certainly something to monitor, how it will actually impact the businesses on, let's say, the financial side. But so far as I can see, that these companies should actually be possible to get compliant with that and actually shouldn't see any implications on the future financials based on that. Now let's talk about news around NIO and the automotive industry in general, which is currently putting heavy pressure on NIO stock price pre-market. And that's about that NIO has just announced a temporary suspension of the production for 5 workdays. And with that also reduced their guidance from actually 20,000 to 20,500 vehicles to only 19,500 vehicles to be delivered in Q1 2021. So the market is seeing this as drastically bad news based on the stock price reaction right now. And that's of course because, well, NIO needs growth. If they don't show growth over time, then the stock will react accordingly to that, right? But of course, if you have listened to the Q4 earnings call, that shouldn't be so much news about it, because actually Li Bin has warned the investors about the implications of a chip as well as the battery shortage. And also, it's a well-known fact that most of the automakers have actually faced this chip shortage. So for instance, Tesla had to shut down the Model 3 production line for 2 weeks. Also, Volkswagen had to drastically reduce actually their output. So it's a real thing. However, I actually also saw Chinese government officials and auto industry officials which mentioned that actually they think in China this problem could be resolved due to a very strong supplier base. But right now, obviously, that is now surprising news here from NIO's side. So in the Dongxi network, I just posted again the Q4 earnings transcript of NIO, in which William Li was already asked about this question. And well, regarding the chip supply and battery supply, he says that it has an overall impact of the overall supply chain. He expects that this will constrain them in the second quarter of this year. So we already knew to expect less output in Q2. He also said that the situation will evolve gradually. So it's kind of, it could be a short-term issue as well. But he also mentioned that he was starting from last year that the team has kicked off the communications and the collaboration with supply chain partners to help sourcing the chips and to have sufficient supplies for the chipset. So that's a little bit of a change here in the communication, because based on this message, actually we could imagine that NIO would have enough chips for Q1 entirely, but maybe NIO was also not expecting to, be able to produce that much in the first place in Q1. As I mentioned before, Q1 is much more bullish than I was initially anticipating. Coming back to this chart, which shows that NIO will most likely grow from Q4 to Q1. Possibly Tesla not even managing on doing that, and Tesla is really the king of scale and output and growing very fast. So even based on this new guidance now of 19,500 cars, NIO, in my point of view, can still manage to have this Q1 over Q4 growth, and that is actually still positive. That's much more than I was anticipating before, and actually, once again, this needs to be highlighted. It is really rare in the automotive industry to see a Q1 over Q4 growth. Usually, automotive industry is super cyclical. Q1 is super bad usually. So it's no surprise usually if Q1 is actually less output than Q4. But that being said, I don't want to play down this issue. If we now see already the problems arising in Q1, that means that they are possibly even more severe in Q2. And this may mean that actually NIO has a weaker outlook with the next earnings, the Q1 earnings. Maybe have to reduce their guidance there for Q2 and Q3. We will see. But maybe if they still can have this 7,500 planned output, then it shouldn't be a bad thing. But if they also need to revise that guidance, that may actually have short-term negative effects on the stock price. And let's see if they still can ramp up in Q3 and Q4. And actually, that's my main picture here. Q3 and Q4 will be the quarters to watch in the automotive industry, and also for NIO. This is when we will see the biggest sales, the biggest deliveries, and also how well NIO can ramp up the production. So for now, this is it regarding the bad news surrounding Baidu and NIO. I'm still bullish on both stocks. I'm also positive on Meituan, which just delivered their earnings. I'm not going to go much more into detail of that. They're up 5%, and also Tiger Brokers has published their earnings, which are perceived well by the markets. It was up more than 15% pre-market, but now it's also coming down a little bit. Let's see what's going to happen in the markets. We've seen those pre-market spikes quite frequently, and then a sell-off after earnings. So don't judge me on that. However, what I can say is that I'm now also back in Futu, a position that I recently trimmed entirely. I also have trimmed my Tiger Brokers, but now I'm actually back in Futu and have also added to my Tiger position again. I will discuss certainly more about those stocks in the next videos. Anyways, thank you guys for watching. If you appreciate this information, please share it, give it a like, and also subscribe to the channel, and then see you in the next one.